Your business is likely running leaner than ever, yet costs to source, build, and ship are rising faster than operational profits can keep up. The erosion happens within your corporate treasury. Right now, traditional bank-held cash reserves are generating a nominal yield of around 4.5%. That yield feels safe until you measure it against the trailing producer price index, the metric tracking the real-world costs of producing goods and services. This chart compares standard corporate yields against industry-specific inflation. While that yield sits at 4.5%, technology sectors face inflation near 8%, and manufacturing sits at 5.1%. This math creates a real negative yield. Your corporate treasury is actively losing purchasing power while sitting in the bank. This loss of capital compounds over a standard 60-month business horizon, creating a quiet but persistent crisis for your runway. A 5-year decay period eventually forces leadership into the margin crisis trilemma. You are left with 3 losing choices: raise prices on your customers, absorb the financial losses, or reduce the quality of your product. Avoiding these traps requires recognizing the root cause. The systemic failure lies in the structural design of the treasury itself. The Anchor Reserves Framework provides a mathematical defense against this supply chain inflation through the 90-10 dual reserve strategy. Under this framework, 90% of your treasury remains in traditional cash instruments to guarantee immediate liquidity. You allocate the remaining 10% to Bitcoin, a decentralized asset with zero counterparty risk and a mathematically fixed supply of 21 million units. Allocating 10% to a hard-capped network acts as a deliberate mathematical offset designed to counteract the debasement of your primary cash position. We can prove the effectiveness of this strategy by running a 60-month comparison between a traditional 100% fiat treasury and the dual reserve model. This line represents the trajectory of a purely fiat treasury, its real purchasing power declining over 5 years. The dual reserve model reverses this, diverging upward to preserve the total portfolio value. The resulting space is the capital expansion delta. This delta represents the precise dollar amount of growth capital rescued from balance sheet depreciation. Rescuing this capital provides the unencumbered resources needed for reinvestment and innovation, providing a mathematical advantage over competitors who remain in a state of treasury decay. When we shift focus from a single balance sheet, we reveal the broader ecosystem of interconnected suppliers and customers. Consider the macro effect when multiple companies within the same supply chain adopt this same 90-10 discipline. Look at this network model. A company with a strong dual reserve treasury can absorb rising producer costs, removing the need to pass price hikes onto their buyers. When that company shares this framework with its suppliers and they adopt it, the input costs for the entire network begin to stabilize. This creates more predictable margins for every participant, resulting in localized supply chain price stabilization. By shifting to proactive capital preservation, interconnected businesses build a collective shield that protects the entire network from systemic economic inflation. Anchor Reserves is an educational publisher dedicated to providing business leaders with this level of mathematical clarity. Our standardized benchmark tool uses public industry data and your selected treasury size range to generate an ephemeral, zero-retention report. Leaders and executives can access the diagnostic tool at anchorreserves.com. Secure your own free 60-month benchmark projection to discover your capital expansion delta and see the math for yourself.